Good afternoon, everyone. I did a risk analysis using Monte Carlo simulation, and later I also did using geometric Brownian motion, which we discuss in the next video. So, what are the steps in Monte Carlo simulation? First step is you have to account for the oil price variation. How are you going to do that? You have to go back historical prices. You have to look at the prices in the past historically, and then you have to come up with some kind of a variation. Normally, it's a normally distributed number. In my case, I didn't look at historical prices. I don't have time, so I just assumed. I assumed a normally distributed number with a mean of 0 and a standard deviation of 40. And I think that's a pretty good assumption because oil prices vary a lot. $40 vary standard deviation is not an unreasonable assumption. And so it could be plus 40 to minus 40 in a given month. And that's not unreasonable at that time. Maybe today it is because the oil prices are just $40 now. But at that time it was 137.5, so $40 standard deviation is not unreasonable. So but this is what I did, but that's not what someone who wants to do a real analysis should do. They should go back, look at historical data for 5 years, 10 years, whatever the amount of time, and come up with the standard deviation number. But I didn't do that. I just assumed this, and it's not unreasonable assumption. And then you forecast the oil price, and then you have two analyses that you could do: the cost to Sri Lanka with the hedging deal, and then without the hedging deal. So you have all these costs, and then you could vary the variation. Depending upon the variation, you would have different numbers, two numbers for each variation. So you would have a phase space, and in that phase space, you would have two principal components. The major principal component is where the highest variation would take place, and you want to stay away from that because it's highly unpredictable. And the minor principal component is where you want to stay. And these components can be found using eigenvectors. And so I did a Excel chart. This is the risk analysis using, so let's see here how to middle this. Okay, so risk analysis using Monte Carlo simulation. So here's the starting oil price here, 137.5, and the variation. The Excel has a function called random between minus 40 and 40, and this would pop up. So if I refresh it, you could see these numbers all going to change. So Excel could give a random number between minus 40 and 40 with a mean of 0 and a standard deviation of 40. And based on that, you could get your oil price. And that would be plus this, and then plus that, etc. So you get your oil price, and the strike price is 112.5 that was in the contract. And the cost to dB, let's say this one, F10. So basically, every time we refresh, you would get a different cost because these numbers are going to change. These are random numbers. So cost to dB is given in this column, and then Sri Lanka has to make a payment to the oil manufacturer, and in some occasions Sri Lanka has to make a payment to Deutsche Bank. If you listen to my previous videos. So this payment depends on the oil price. Now here I have an equation here, if equations, and if the oil price is 128.5, then the Deutsche Bank is going to pay us $10, and we pay oil manufacturer 118.5. So our cost is 118.5. But on the other hand, we don't have to pay when the oil price is more than 112.5. We don't have to pay Deutsche Bank. We pay when the oil price is lower than, in this case, is 69.5, and then we have to make a payment to Deutsche Bank. And we have our costs here, SL cost. I have one column with the hedging deal and SL cost without the hedging deal. And these are the numbers, the total numbers. This is the, now if I refresh again, another simulation, with the hedging deal, 215 million, without the hedging deal, 229 million. So it's another one, another simulation. I just press F9. And then SL cost with the hedging deal, 203 million, without the hedging deal, 172. We are less. We pay more with the hedging deal. Another simulation, F9, refresh. And this one, SL cost with the hedging deal is 327, without the hedging deal is 347. So here we save money. And here I have a chart here. Let's see how to get this chart on the dot here. Something like this. Now I can see, I think. So oil price chart on one side, on the left hand side, and cost with and without the hedging deal. So in this case, if the oil prices are like this, then our cost, orange line is cost without the hedging deal. So without the hedging deal, we are paying a little bit more. As you could see, there's a $10 gap between our payment in this simulation. But let's do another simulation. F9. Oh, why is not good? F9. And now, as you could see, in this simulation, we are paying flat rate of 112.5. We are paying flat rate of 112.5. When the oil price goes down, we just keep paying to Deutsche Bank. This area is the profit of Deutsche Bank. That's a big profit. And let's do another one, F9. In this one, when the orange line is above the blue line, then that area is our profit. And then here you have orange line going below the blue line, that's their profit. So in this simulation, it's kind of evening out. And this one, again, our profit is this little area, and this big area is their profit. Let's want another one, F9. So they got a big profit. So basically, if the oil prices go down, we are screwed. We are paying a lot. If the oil prices, do another simulation. If the oil prices are high, then again, this is kind of low prices. Let's do another one. And again, so we pay more. It looks like, for the most part, we are paying more for most of the simulation. Now, what we can do is we could create a phase space, and we could find principal component axis that you have used eigenvectors, and then where that major component axis that you would see, that's where you don't want to be. You want to be in the minor axis where the predictions are much simpler. Yes, and next one we will be looking into geometric Brownian motion risk analysis using that. Thanks for listening.